The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
With so many people living longer, the fear of outliving your money becomes a reality for many of us. Will I be a financial burden? Will I outlive my money? How will I be remembered? My name is Neil Himmelstein, president of Main Street Planning Group. Please contact me by visiting mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. I will introduce you to strategies that will guarantee you will not outlive your money, that can guarantee you will not be a burden on your loved ones. Through a collaborative approach, we will uncover solutions that offer tax-efficient strategies, lifetime income, and legacy planning, choice, organization, direction, and education. That is the code we stand behind. Contact mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. And listen to me every Friday at 3 p.m. as I host the Main Street Code for Financial Success, right here on 103.9 LI News Radio. Good afternoon. Welcome to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. I'm here every Friday at 3 o'clock. If you miss me, you can catch me on Apple or Spotify, themainstreetcode.com, which is my website. You can check past episodes, and we help hundreds of advisors across the United States in the area of life insurance, annuities, disability, long-term care, and life settlements. And we want to guarantee you protection, and our goal is to bring Wall Street to Main Street. And we're here every week going through all kinds of concepts and ideas and feeling the pain and answering the questions of attorneys and trying to give you the best financial solution for you. Every financial solution and problem is unique to you, and you should have unique answers. So we're completely independent, represent 30 different insurance companies, work with tons of attorneys and accountants. We like to work as a team. The team approach is the best approach because no problem is simple without making sure it's tax efficient, and works for you and protects you the most in your planning. Today I want to talk about a very old concept, and I just want to open it up by saying, if you had a crystal ball and you knew the perfect time to invest, wouldn't that be great? But you don't have one. So what if I told you you really don't need one? You don't need a crystal ball. There's a strategy that takes care of all the guesswork. It's been around since the beginning of time. And I want to go back to basics. It's called dollar cost averaging. And what dollar cost averaging is about is investing a fixed amount of money at regular intervals. So whether it's weekly, monthly, you think, I'm going to spend that amount of money. This is why 401ks have been so successful. Because people have it coming out of their paycheck every week, or every month, or whenever you're getting paid, and they're buying on a regular interval, and they're not watching, is the market up, is it down? That's how you build real wealth. It's called dollar cost averaging, and instead of trying to time the market, you're buying on a consistent basis. And I like to look at bananas in the supermarket. Okay, 1 week it's 29 cents a pound. 1 week it's 49, 59, 69, 79. Okay, if I put down $1 and bought bananas every week, okay, this week it's 59 cents a pound. So maybe I'll get 3/4 of a pound. I'm just using averages, okay? Next week it's 49 cents a pound. That's easy. I got 2 pounds. The following week it's up to 79 cents a pound, but I'm still spending that $1 to buy bananas. Maybe I'll get a few less. Over time, I'm going to accumulate more bananas, and hopefully they're not going to rot on me by doing it in this manner. I'm going to catch the very lows of the market, the lowest price, and when the market's higher, I'm going to be buying less. But isn't that good? I'm going to be buying less when it's higher and more when it's lower, which is exactly what you want to do. And that's how dollar cost averaging works. And it's very important to keep that in mind. Now, there's another concept out there, and it's called something else, but I call it dollar cost averaging when you're spending money. So what does that mean? So if I want to get out of a stock, or I want to, see, this removes by dollar cost averaging, you're removing the emotion and the stress of buying stocks, okay? The problem is that if you turn on the TV, you turn on the radio, there's this financial guy, and buy this, buy that, and the market's going up, and the market's going down, and it's forcing people to be day traders. And it's not the way to accumulate wealth, is to be a day trader. Okay, I'm sorry, because the last couple weeks, we've seen the market take a tumble. Oil prices are through the roof. This goes up, this goes down, this goes down. All these fluctuations really hurt people. So we want to smooth that out and be consistent buyers, not, okay, so we're going to reduce the timing risk. We're going to build discipline. And it works for everybody. It's amazing. You look at Warren Buffett, and the market has changed tremendously. You look at somebody like Warren Buffett who did this, and you look at the stock market, and he would buy companies that he believed in. That's his philosophy. It was always the way I was brought up, is buy companies and stuff you believe in that you think is either going to go up or is going to be steady and give you some kind of income, safety. Going to give you safety and growth. Safety, growth, safety, growth. Consistently, safety, growth, okay? Not okay, I got $10,000, let me push it into, cannabis stock. Oh no, wait a minute. Cannabis stock went down because there's an oversupply. Well, let me shift it into, AI. It's not the way to go because you'll take a big hit. There's a big risk there, and then you're stressing, oh my God, I bought it the wrong time. Not good. If you bought consistently, you can balance this market out and win. So dollar cost averaging is patience and consistency, and you don't suffer the, oh my God, the panic. Now, I like to talk about, behaviors and everything else. I want to talk about dollar cost averaging when you sell, because this is the problem. What most people do is they panic sell. Now, if you're 30, if you're 40, you can recoup from panic selling. I have some young investors that recently came to me that did great last year in the market, and they sold when it was high. They did the right thing. Okay, great. What they didn't account for is they have to pay big taxes on the capital gains. Now, here we are, it's tax time. And they have a dilemma. They got to pay all this money in capital gains. They put all the money that they gained back into the market. The market has dropped, and now they're saying, I have to sell everything to pay my taxes. What a horrible situation to be in. Now, if you're older, you're at retirement or near retirement, you can't afford to take this kind of hit. But do you sell it all at once to pay the taxes? Or should you be selling it in pieces, a little bit at a time? You wouldn't have had such a tax burden. And even if you have taxes to pay, if you sell a little bit about a time, you're not going to take that big hit. So when you're in that distribution phase, or even if you're not, if you anticipate you're going to need money, or you're in that retirement phase where you have to take money, you want to take out regular investments just like you put in regular investment. They call it systematic withdrawals or systematic thinking. Now, my goal in helping you and everyone is taking out the bumps of the ups and the downs and giving you, for instance, a guaranteed income for the rest of your life. Wouldn't it be great if I didn't have to worry who's getting bombed today and who isn't? Wouldn't that be great to know that my money is protected? Maybe not all of it, but isn't it nice to know that I have the amount that I need is protected, that I know it's coming to me today? And that's what a guaranteed income portfolio will do for you. Annuities can give you a payment for the rest of your life, so you know you have that guaranteed income. Life insurance can give you protection, so if something goes bad in the market or whatever, or I have a major health event, I can leave that to my heirs without taking that financial hit of that big market hit. These are the kind of tools we use to help you smooth out the bumps in this bumpy road that we're on. You're listening to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein here. I'm here every Friday. Best way to reach me is 631-647-4694 or visit me at themainstreetcode.com. Thank you. Welcome back to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. Once again, prior to the break, we talked about an old and tried thing called dollar cost averaging. You know, you turn on the news today and I say there's like 20 different TV channels that talk about the market. The market, the market, the market. Buy this, sell this, buy this, sell this. And we all get caught up in this hysteria. And I see a lot of young people today, and I saw this 30 years ago. You know what? There's nothing like experience that teaches you things that go on in this environment. But 30 years ago, probably even before that when I started in this business, the market was booming. In the 90s, the market was booming. People were trading. You see people today that have done really well when the market was up. All of a sudden, they got their computers at their desk and they're watching the market 24/7. 24/7, I'm buying, I'm selling. All of a sudden, they think, no matter what profession they're in, they think they're market experts. They're timing the market. They're doing this, they're doing that. I've seen attorneys stop being attorneys and become day traders. I've seen insurance salesmen stop being and become day traders. I've seen people of all walks of life thinking, oh, while the market's good, all boats rise, everything's great. I'm saying this, I saw this 30 years ago, and none of these people are doing what they were doing 30 years ago. Why? Do you think everyone was a success? Do you think everybody made it? No, a small percentage kept their gains. The rest gave it back and went back to their professions, if they could. I worked with a guy 35 years ago, 40 years ago. I'll never forget when Atlantic City was booming and everything else. You'd go down Atlantic City and come back, and almost every week it'd say, oh, I won $2,000. You always hear about the wins. You don't hear about the losses. You know what? It's the same thing with the stock market. You hear about the wins. You don't hear about the losses. So don't think the guy next to you is doing so super fantastic, but the media and everybody is turning us into gamblers. Listen to how bad things are. In the last 10 years, they came out with something called cryptocurrency and Bitcoin. Then they came out with NTFs. Does everybody remember NTFs? Last year, that was the hot thing. NTFs. What were they? They were these memes. They were these pictures. They were selling for $250,000 for an image. Like, what the heck is that? We talked about Warren Buffett. Warren Buffett bought companies. He bought Coca-Cola. He bought Home Depot. That's what he bought. These were companies. These were things that were growing. Microsoft, NVIDIA. These are real companies. Now we're buying memes, Bitcoin, crypto. I'm sorry, I don't understand blockchains. I'm a pretty smart guy. I understand enough to know that it's not tangible to me. Now they have predictability markets. This is insane. You can bet on every pitch that the pitcher is throwing today. One line. There's predictability. They're making us gamblers. You have to resist that temptation to be a gambler, yet 24/7, before every ball game, I'm a big Knicks fan. And for those of you who don't know it, I love watching basketball. I love, baseball sometimes. I like the home team. I love sports. But before the game, you have FanDuel, this one, Caesars, and they're talking about betting and great, and everybody gets caught up in this thing. Like, we are not, you can gamble your fortune away. I want to protect you. So dollar cost averaging in investing isn't talked about anymore. It's so basic. Invest every month, invest in good stuff. And then the next thing you want to do that you don't want to get caught on is you want to diversify. You want to diversify your assets. Listen, everybody ran to cannabis when cannabis became legal. Everybody's buying cannabis. Where's the cannabis stock today? Everybody bought Bitcoin and then went down. It went up. It went crazy. Well, now it's down. Is this how you want to live your life? And then they're running to AI. And AI is fantastic. Great. Look, it's controlling the world. Fantastic. But you got to invest in multiple things. Oil just shot through the roof. Now it's down today. It's up. It's down. It's up. Is that how you want to live your life? You're going to be on the wrong end of the stick every time. With those short-term gains, you need to hold on to them. You got to take some things off the table when you're near retirement. You have to diversify your assets. And the other thing that we want to talk about is diversifying your tax classes. It's not talked about enough. What do I mean by that? If I'm buying and selling stock, I'm paying tax. Every time I got a gain, I'm paying tax. If I have a loss, I can kind of offset it. But we are not geared to worry about the tax until the end of the year, and all of a sudden got to pay this big tax. Mutual funds that you buy inside your 401k or an IRA have this great advantage because what a mutual fund company does is it buys and sells stocks. Now, they usually have a rationale, whether it's growth or it's safety, and they're going to buy and sell these stocks. One of the things people don't realize, if you buy mutual funds on the outside of this of your 401k or IRA or Roth IRA, and you buy them on the outside street, you could that could have big gains, and the mutual fund, the money manager inside that could be selling stocks at profits and losses, and at the end of the year, you could be, let's say you put in $100,000 in a mutual fund. At the end of the year, that mutual fund could be worth $90,000 if it lost 10%, yet it could still be taxed. You could still pay taxes on that. Why? Because they sold stocks during the year for short-term gains, and they bought things, and they could have created taxes, yet the value of the whole portfolio could be down, and you still pay tax. It's a crazy concept, but it happens all the time. People don't realize. That's where an annuity takes place. Because an annuity, you can buy and sell mutual funds, essentially, and mutual funds can buy and sell stocks inside an annuity. We're talking about a variable annuity. I don't handle variable annuities, but I'm just telling you the basic concept. And that money isn't taxed until you take the money out. It's all protected. So you don't pay that tax even if it's a loss or a gain. So it's investing with some protection on top of it. Now, one of the things I deal in is fixed annuities. Now, fixed annuities rise and fall with the 10-year Treasury. So other than a CD and everything else, you get that protection mechanism when you invest in an annuity. So if you invest in an annuity, and right now you can maybe get 4.5% in New York, outside New York, believe it or not, you can get more. There's a whole reason why, and I can tell you why, but for argument's sake, let's say we could get 4.5 today. And let's say if you put your money in a CD, you got 4.5. Well, that CD is taxed every year on that growth. So if you're in let's call it a 20% tax bracket, you take 20% of that growth of 4.5, and you're paying that at the end of the year, every year. So that 4.5 is really, 80% of that is really, I'm sorry, I'm doing the math in my head. It's really 4%, let's say. Okay? Or 3.8%. I don't have the exact number in my head, I'm sorry. But it's a 20% less than you're making in that than if it's in a fixed annuity. Now, year after year, you're going to have that total amount invested in the annuity, yet the CD, or what I like to call a certificate of depreciation, and people get mad when I say that because so many people have CDs, but it's really a certificate of depreciation because it's depreciating because you're paying taxes on it every year. The annuity, you don't have to pay tax on until you take the money out, and you only pay tax on the gain, not the whole annuity, just on the gain. So by deferring those taxes, you have that much more money at the end of an annuity period. So you have to diversify your tax classes and you have to protect your money. Life insurance, you have triple tax protection. And that we can talk about on for days. I can't believe we're running out of time. But this is why there are different products and different solutions for everybody. Dollar cost averaging is what we talked about. Diversifying your assets and diversifying your tax classes is so important, because that's the unknown partner. That's the partner that's going to depreciate our growth. You've been listening to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. I'm here every Friday at 3. Best way to reach me, 631-647-4694. Thank you. Have a great week, everybody.
The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.